Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.
You are listening to the financialsurvivalnetwork.com. I'm Kerry Lutz on 1230 WBZT. Well, we've been living in illusion, a world of illusion, not quite Alice in Wonderland, but pretty close, and reality is coming back, and it's going to bite everyone you know where, and that's why we've got Bob Hoye on with us now. You know him well from institutionaladvisors.com, and his capitulation model has been on the money. He's going to talk about it now. Bob, welcome back.
Good to be with you, Kerry. Yeah, this is a good week to be talking. I think the keynote should be, at the moment, the stock market, which, and I just wrote a piece saying that you can have a bull market, and that's fine. You can get intermediate swings on it. And then all of a sudden in, 6-8 weeks, it turns into a culminating bubble. And I think this is why the Federal Reserve, candidate Janet Yellen, a few weeks ago, said that they saw no sign of mispriced assets, no bubble, that. And I think that's because they're always running about 2 months behind where the market is. So the final thrust here in the stock market is very exciting, and it compares to 2007. The percentage gain is greater, and but we're getting up to very high momentum on the RSI, and here we've got the numbers.
That's the relative strength index.
Yeah. So from the crash it ended in 2002, the S&P gained 105% of the high in October 2007. And with that, the monthly RSI got up to 79.6. And then if you look at the end of the 2007 crash in 2009, the gain's been 172%. That's pretty good.
Wow.
And then on that, the monthly RSI is up to 76, which is the highest, since 2007. So, and then that's momentum, which shows enthusiasm. And then there's the other way of determining excesses is through sentiment figures, and you take a look at the percent bears, and it's now down to 13.7. And according to the service we get on this one, it's the lowest since 1987. So the bullish sentiment has been terrific. And so the way we work on this is that once these excesses started to really show 4 weeks ago, then you look at seasonal highs. Now you can also, the Thanksgiving weekend is often very positive for the stock market. And then the next positive is you can get a rally in small cap stocks that goes out till the first few trading days in January, and that's a positive. And then you look back in history, and the Nikkei blew out infamously right at the last trading day of 1989. So you can have turn of the year tops. So as it's turning out, it looks like the high was on the S&P was on Friday, the Black Friday shopping day, which was the Thanksgiving weekend. And then you would look for, you've got the excess, you got the timing, and then you look for the first week with a lower low than the week before, which was last week. And we noted that, and then you had a quick rebound in the S&P, and then in order to take out the last week's low, which was 1779, it had to get below that, and it's below that now. So, and the Dow Jones has also taken out the low of the previous week. So the key one was the first week with a lower low, and then you get the bounce, and then if it takes out that low, which we are now, so this is quite definitely turning the stock market down. And then when we looked in Shanghai, Hong Kong, and Southeast Asia, those markets are stair-stepping down in the last 3 or 4 weeks. So it's a universal global turn in the markets from exceptional speculation. So we then have, I think it has to go a little lower before we'd say that it's a bear market. Also, you have to get through the positive towards the year end and the so-called Santa Claus rally. But on the big stock market, Kerry, it looks like damage is being done this week. And on the other side, the things we trade, the mania in lower grade bonds has been unbelievable, and mainly because there's been the Fed bid in for subprime mortgage bonds, and we look back to earlier in the year when there was a powerful bond rally going on in April, and there's an old rule of thumb that if you have a good speculative move in the bond market in April, the chances are there'll be the seasonal reversal in May. And of course that came in, and it went real fast, and eventually we called it a mini panic, but it went from very overbought technically, and then on the first crack about 4 or 5 days later, that's when Bernanke got up and started to discuss the taper concept of stopping the buying of bonds. But at the time, we wrote that this was an attempt to look like they were in charge of a rise in interest rates. But then, of course, it turned out to what I said, we called it a mini panic. So just as it was getting extremely oversold, then Bernanke got out, got worried about it, and said, oh, well, we won't be doing the taper for some time, and then you had the recovery, more on technical grounds than anything else. And there's where our thoughts then was once you got that whack in the bond market in May, June, that you would stumble around, recover sort of thing through the summer months, and then somewhere later in the year, that the past would suggest that you'd get another hit to the bond market. Well, that hasn't happened. The Fed has maintained its stance and its buying, but throughout all of history, either the Fed or the Treasury buying of bonds, there comes a time when market forces overwhelm them and they get killed, because back in the 40s, 50s, and 60s, the Treasury was buying bonds in an attempt to keep the yield from going above 3%. Eventually got to 14. So, and then we know that the relentless bear rate on gold, once it was, ended at 253, once the tide turned on gold, then no amount of central bank selling could change that.
So are you, in other words, telling me that happy days are not here again, Bob?
Well, let's say for the orthodox side. But what we're doing is this then is setting up the opportunity in gold. And well, way back when I started in the business, I was as a trainee working in Wood Gundy's head office in Toronto and as an assistant mining analyst. And you'd see it at the end of a trading day. They'd say the New York industrials and the Toronto industrials were strong, Toronto golds were weak. And then another time, if the golds were strong, the industrials would be weak. So after watching this for a number of months, I was talking to one of the veteran traders there and said, why does this happen? And he looked me in the eye and he said, Sonny, that's the way it works.
That's the way it works, huh?
Yeah.
Because, in other words.
Yeah, there was the opposite action between industrial index stocks and the gold miners. So then that went away in the 80s and 90s and et cetera. But beginning in September 2012, that started to come back in. That was on the rebound out of the hit that began in the first half of 2011. So now to look at the golds, it's always great to look over one's shoulder, and that high in September 2012, and with, of course, on any rally, silver will rally faster than gold. So we do the silver-gold ratio, and whenever the relative strength on that one gets up over 78, you're in pretty speculative terrain. And in that September, it got to 82, and we noted that that was dangerous speculation, and there had to be a sell-off, which we got. But going back to last spring, we were early on getting back in, but eventually, the problems resolved itself and you get a few rallies. But what we're looking at now is that this is on the precious metal sector, a bottoming action. It could take 4 or 5, 6 weeks, and this is bottoming action against the stock market, which until this week was in topping action, and now I think we can call it breaking down action on the stock market. Now, also, there could be some help for the precious metals from the base metals. These, in the first quarter of 2011, got hugely overbought. I mean, big time. And it triggered off one of our rare calls from what we call the momentum peak indicator, where then we called for a cyclical bear market in base metal prices, and which we did get. Also, I should say in full disclosure, Kerry, that we also called that indicator, when it triggers off, it usually indicates a recession, which did not happen. I don't know why, but it sure had the excesses in the metal prices. So we're not looking for the opposite to that in base metals. We've got some good lows in here, and we think stability and maybe even a rally into February on base metals is possible when there's no liquidity crisis going on the big stock market. So that then would help the gold and silver side, and then also crude a few weeks ago got very oversold and has moved really fast to an overbought. But nonetheless, we think crude oil's past a tradable low, and we can get a tradable recovery in it for maybe into January, February. So there's a case for stability in the gold sector, and there's also a case that this would be the start of a new cyclical bull market for precious metals. And that would be within the context of a cyclical bear market for orthodox investments, such as in stocks and low-grade bonds. So it's going to be very exciting, and when it finally turns, because during the 1930s, the precious metal sector was a fabulous performer when everything else was in the tank. And also that was the case during the Great Depression of the 1870s and 1880s. You had the real price of gold going up during a Great Depression, and that then benefits the gold mining side. And it's interesting how Mother Nature behaves in a great bubble, and then the contraction is that in a bubble, the real price of gold goes down, which generally has been happening with our bubbles. And then once the bubble's over, the real price of gold goes up. So, and this is as you get two kinds of things going on in a credit bubble. You have the normal instruments of credit expanding hugely, and then of course they invent all kinds of new different credit instruments, CDOs and all that sort of stuff. So then in the contraction, those things, all the invented new things kind of really get beat up, and then the normal instruments of credit contract. And that diminishes global liquidity. So then Mother Nature raises the real price of gold. Gold miners go out and increase their production, find more of it. So the gold, even though the policymakers may hate gold, it'll flow back into the banking system and begin to put liquidity into the system, real liquidity from gold, while the great credit contraction is on. So on the big picture, it looks very good. It's just that the next month or so could be a bit lumpy in getting positioned. But I think we could say that one should, on the really bad days, begin to accumulate some precious metal stocks, looking for a cyclical bull market.
So And we're going to talk more about this up next on the financialsurvivalnetwork.com 1230 WBZT. Hi, it's Kerry Lutz. I recently decided to move my retirement account into physical precious metals to hedge against the coming times. If you want to move an existing retirement account into physical precious metals that you can hold in your hand, tax-free, there's no company that can do it more quickly and efficiently than Regal Assets. It took them just 24 hours to open my new IRA account, and all I had to do was fill out one simple form. The best part is that Regal Assets does all the work for you. They cover the setup and administrative costs for 2013. If you're interested in making the same move I did, call 855-678-6620, 855-678-6620. That's 855-678-6620, or visit them at regalassets.com. You'll be glad you did, and tell them Kerry sent you. And we're back. I'm Kerry Lutz. We're speaking with Bob Hoye, master statistician, historian, market historian, and a whole lot more. So, Bob, couple of questions. A lot of people have been bullish on housing the past year and a half and bearish on mining stocks. So you think those two sectors are going to flip?
Oh, yeah. I'm glad you brought that one up because there was one segment of Shiller's house index in U.S. housing. I think it was up 20% year over year.
Yeah.
Recently reported.
Up
and of
big.
course, in Canada, we didn't have the bear market and collapse that the U.S. suffered. And of course, Vancouver is the premier speculative place for housing in Canada because of the Asian bid. But going back to 1980, which was a huge high for gold and silver and crude oil and a bubble and everything, positive times, and the house prices in, we call it the North Shore, which is sort of expense account land, business executives, all that sort of stuff, nice houses. Well, those house prices fell to 1/3 of the high.
Wow.
During the 80s. And then there was other one. I remember in Toronto there was some promoter was charged with malfeasance. And the trust company seized his house, and this was a high-end house in a nice upper-scale district. And the Financial Post wrote it up about every 6 or 9 months, and it took about 4 years before the trust company unloaded it, and it was at 1/3 of the high price. So it's amazing. And then even here in Vancouver, where the high-end stuff fell to 1/3 of the high, your average nice home fell in half. So, it can happen here, and you can have another decline in average home prices in the U.S. A post-bubble credit contraction takes a long time and a few business cycles to get rid of all of the excesses, and sure, the 3 to 4 year business cycle continues on as we have here. Now, here's where there's another comparison, is that the business cycle out of the 1929 crash ran for 4 3/4 years, and the bull market ran for 4 3/4 years. And here we're out of the crash that ended in 2009, and it's 4 3/4 years for the economic recovery, and 4 3/4 years for the bull market in stocks, and the recovery has been weak. Now, this is the typical post-bubble condition where it starts with a horrendous collapse, and then weak recoveries, and then another recession. So the timing on this looks like the economy is mature on a time basis, but not mature in the sense that it's been a robust or a strong economy. But then in a post-bubble contraction, the recoveries are weak. So, and then here's the other thing, is that you're getting some pretty good numbers on the economy right now. And but we think that can change fast. It's not like the older days where you'd have a peak in the stock market, and then 10, 12 months later, you'd have the peak in the economy. In 2007, you had the high for the stock market in October, and the recession, according to the NBER, started in that December. And that was the case in 1929, where the stock market peaked in September, and the NBER determined that the recession started in that August. And then even the NBER had the business cycle back to 1873, when in the U.S. the stock market peaked in that September, and the NBER said that the recession started in that October. So our guess here now is that the stock market is rolling over, and it will be seen to have taken the economy with it.
Hey, Bob, one other thing about these statistics. It seems like they're a lot more, shall we say, politicized nowadays than perhaps they used to be. And obviously, you being a numbers person and very analytical, you have to put some more adjustments into them, don't you?
Well, we've got John Williams with his shadow government statistics. That's a good service. It shows the nonsense that's going into calculation, and they're pushing. And the unemployment figure is just so bizarre, I don't even follow it.
It's Orwellian.
To follow is
it's Orwellian.
The percentage of Americans that are working, actual working. So that
not
is,
for the government, because working for the government's an oxymoron if there ever was one.
It's like the Russians used to say that we pretend to work and the government pretends to pay us. But no, there is so much fiddling, phoniness in the system, but there's things that you cannot distort, and the one is commodity prices. Mm-hmm. And over time, they cannot distort precious metal prices. I know that the gold bugs and the silver bugs they do supply-demand analysis, and according to their calculations, the price of gold and silver should be very much higher. Silver and gold are trading off of the business cycle. The policymakers would like to have the gold prices down, but it ain't going to happen. When it's time for gold to go up, there's nothing they can do about it, and it's going to be the same for the bond market. When it's really heading south, there's going to be nothing they can do about it. And last May, June gave us the hint on that, because they kept the bid in, and they got hammered. So this is more than just a post-bubble recession coming up and another post-bubble leg in the bear market. It is also a test of the abilities of central banking, and the theories that follow central banking is that the folks are going to take a look. Say this market does really cave in here going into the new year, and the folks are going to say, look at all of our taxpayers that you guys risked on the QEs, bidding up hopeless asset prices. And I think this is going to be the time when the folks really take a look at all of this interventionist stuff and say, ain't working, guys. You've had your turn. You're out of here. Yeah. And the collapse of central banking would be a wonderful event, because it's been a whole lot of nonsense. This is the month.
That's a great
Actually,
point.
It was December 23rd, 1913.
100 years. 100 years. We're going to be celebrating.
Yep, I've got an essay that's going to be published in one of the Canadian newspapers. Fed at 100 years and 100 mph, 100 miles an hour. And,
with blood alcohol level at 0.35. And I want to tell you about one other premise that I have here, Bob. 1934, FDR gets elected in 33, inaugurated in 34. 18th, I think it was the 18th Amendment, and I'm a lawyer, so if you really want to get down on me, please do. But repeal of the Volstead Act and happy days really are here, because you can make that be a BAC go up as high as you want now, and the government's not there to stop you. And now, Bob, we're seeing repeal of marijuana laws, which is a parallel to the 30s. And you're going to see more and more and more of that, which is a parallel. And you being the historian, the economic historian, to me, that is also economic history repeating itself, because prior to the imposition of the income tax, which I believe was the 16th Amendment, and again, if I got the numbers wrong, don't give me nasty emails, the primary source of economic sustenance for the government was excise taxes on alcohol. And, you know, this is going to repeat itself with the end of prohibition of marijuana.
Well, I always thought once they figured out how they could tax marijuana, it would be made legal. But you have here an ideology of control that's been on for 100 years, and if they can't inflate credit, that's the lifeblood of the state, and then taxations are the limit, and that's the lifeblood of the state. So I think that we're looking for a new bull market in common sense amongst the public, and the current administration has been doing stupid things, healthcare, and a full commitment to the nonsense of man-caused global warming. And so I think, well, I took a degree in geophysics, and I've always known that the man-caused global warming thing is a load of bull. But
the nasty emails are going to be coming from that one, Bob.
You want to see, what you want to see is that where somebody with experience or data can see that it's nonsense, the public has to see that it's stupid.
Oh, yeah.
So the public will see that the experiment in central banking is stupid. They'll see that the takeover of the healthcare system is stupid. And they will then eventually see that the whole business about, the audacity where these guys think not only can they control the economy, which lately has been seen not the case, but they can control the climate. The ego and the audacity is staggering.
It's breathtaking, and it's
so anyways,
hubris.
I think this is now in previous experiments in authoritarian government. One ended in the early 1600s, and the other one was the 3rd century in Rome. And each of them ran for about 100 years. The bureaucracy really runs things. The political parties are just like football teams. You have an offensive and a defensive team, but the bureaucracy is running things, and it wants to control and consume everything. And the money seems to run out at the same time as the public discovers common sense. So this is where it's important. This control game has been on for 100 years, and it's got distortions in the financial markets like you can't believe. And the public is going to discover it, that it's been whole nonsense. So I'm really excited. I think this is ending action on the experiment by the control freaks.
Well, we can only hope that that will be the case. Anyway, we got to wrap up, Bob, but just give us your website again. And
you can. There's two ways of getting in. One is just institutionaladvisors.com, or I've discovered recently here that if you just Google my name, Bob Hoye, all the stuff comes up. And we have, if you're interested in taking a subscription, we'll run you for 6 or 7 weeks. And if you like it, you take it. If you don't, there's no cost. So
that's what I like. Low pressure, low key salesmanship, and everything on the financialsurvivalnetwork.com is free. You can also order my book if you like, $20. Just click the link, financialsurvivalnetwork.com. And of course, in the show notes, got a link to Bob's site, and I highly recommend it. Bob's a historian, and they don't teach history in schools anymore. Even when they did back when I was a young pug, they didn't teach economic history. They've never taught economic history, Bob, in any school system that I'm aware of. And that's much to the to the disadvantage of all of us, of all of you, because the real history of humanity is found in economic history, because that's why you do things. That's why things are so screwed up. Anyway, Bob, it's always a pleasure. Great to talk to you. Enjoy the holidays. Merry Christmas, Happy New Year, Happy Hanukkah, all that. And we'll talk with you again after the first. And I think you have made some really prescient calls that we're going to see come to pass very shortly.
Thank you very much, Kerry. Good to be with you.
You too. These are tough times, and they're getting even tougher. The clock is ticking. The countdown to collapse is well underway. What are you going to do about it? Will you just wait for it to happen, or will you be ready when it happens? The decision is yours, and yours alone. Join myself, Mickey Fulp, Robert Ian, David Morgan, Jeff Berwick, Elijah Johnson, Alan Butler, Gregory Manarino, Daniel Amaduri, Andy Hoffman, Tekoa De Silva, Trace Mayer, one of the world's leading Bitcoin authorities, Bix Weir, Jay Taylor, and Gary Christensen at the Liberty Mastermind Symposium in Las Vegas on February 21st and 22nd, and learn how to create your plan to survive the collapse. The last Liberty Mastermind Symposium was one of the most highly rated conferences ever, and this one promises to be even better. Don't miss it. Join us and register now at libertymastermind.us. libertymastermind.us. This one is going to be out of this world, and it's going to be even better because it's in Las Vegas, Nevada. Go to Liberty Mastermind US and sign up today. Summer is almost over, and so far we've really lucked out. No hurricanes. And living in Florida here, I'm extremely grateful, but that could change tomorrow. And look, we're about to celebrate the 1-year anniversary of Superstorm Hurricane Sandy. Do you remember that one? Not very many people in the Mid-Atlantic or the New York area region were prepared for it. But if you had PrepareWise emergency preparedness food, you were ready. If you'd prepared with PrepareWise water and the basics, some currency and a means of self-defense, you weren't caught off guard. And if you weren't prepared then, please learn from it and get prepared now with PrepareWise emergency preparedness food. It always pays to prepare. Go to preparewise.com, use the code Lutz. You'll get great savings. Depending on the size of your order, you're going to get a whole lot more. Be prepared. Don't be caught waiting for the government to come and save you. Preparewise.com. Use the code Lutz, L-U-T-Z. Be prepared.
The Financial Survival Network, helping you to survive and thrive in the new economy. Get our complimentary newsletter at financialsurvivalnetwork.com. This is the Financial Survival Network.